you. Today is Wednesday, the 5th of August, 2026. My name is Francisco Gaffney, and this is my daily stream all about governance, risk, compliance, and advisory boards. So this week, I'm going through the 4 milestones of the model of the advisory board operating system. So on top, we have scale, on the right, predictability, at the bottom, we have systems, and on the left, we have edge. And all this to build a 90-day advisory board action plan. Because the reason of this is that when people show all these models, right, like the ones that we have in front of us, it all seems theoretical and leaves you wondering who's going to implement these and what business outcomes it will produce for your company. So as a result, this week, I will go through all these model and make it very practical. So you can bring home a precise blueprint of what to do, when to do it, and with whom, right? So yesterday we spoke about scaling, which is the top of the model, the commercial acceleration, whether brand, your brand, your people, and your partnerships are ready to carry that growth that you're looking for. And today I'm going to focus on the right-hand side of the advisory board operating system, which is growth and capital. So that's the predictability, the partnerships, the revenues, and the assets. That's where make the company fundable, right? So I'm going to focus on this section today. Partnerships, revenues, assets, predictability, so your growth and your capital. So this is, how I can put this, where the mood often changes, because I will specifically talk about capital, money. And money asks very cold questions, right? So when you go to an investor, or when you go to the bank, or when you go to the shareholders, it seems that everything is very difficult. So questions will come, and perhaps you're not prepared for that. And some questions will be like, is the revenue repeatable? Or are the margin clear? Where do the assets sit, right? So your intellectual property, your processes, your workflow, your operation procedures. Are the contracts clean? Can the numbers be checked? What risk is the investor usually being asked to carry? So if we are investing here, what are our liabilities, our risks if we invest with you? Many founders believe the business is ready for capital because the market appears to be pulling, right? So everything looks fine. The customers are interested. The pipeline is active. The products they have the unique selling points. The market is large. You have a large TAM or SAM. So the company only needs money to move faster. But that's your thinking. And all that might be true, actually. But the next step is not always fundraising. The next step is making the company fundable, right? So you can have all those elements ready to go, but it is a company prepared to be funded, right? To that acceleration that you're looking for, that expansion, that growth, that scaling. So let's take 3 problems with this. And number 1 is that revenue exists, but it's not predictable. One of the questions that usually are coming through or never asked, and you say, why this never happened? Well, this is one of the big ones that are coming from the side of the lenders. Business can have sales and still have a weak revenue quality. Orders may be one-off, margin might vary sharply. Like 1 year you have peaks of sales or revenues rather than a steady, continuous revenue. And you say, well, but actually at the end of the exercise, I'm good. That's correct. But actually that instability also are indication of heroics, efforts, things actually are done on one-off activities. It's something that we mentioned yesterday, heroics of the founders of the executive teams to pull these absolutely fantastic results, but actually you have to do that all over again. So the cash may arrive late. That's another issue that might have, and customers may represent too slow of the number. So it's too much risk on 2 or 3 key customers. Delivery might cost more than expected. Well, there's a plethora of things that to consider here. So you, as a founder, or one of your senior teams always will still require to close every serious opportunity. And that is all things that are considered concerns or risks. So the capital will look at the quality of the money, not only the amount. So this is all referring to the quality. How good is or predictable and stable is at least the baseline. I know you have a portion that's going up and down. That's perfectly fine. But the core of the business, what actually make the debt payable, need to be predictability, need to be predictable, right? Or a great percentage of that predictable, or how you plan to make it predictable. Problem number two is that assets are claimed, but their ownership is not is unclear. So the company talks about its products, intellectual property, brand, data, contract, a customer proof, or distribution rights, right? But which entity owns them, right? So if you have intellectual property or intangible assets, who owns them? What has been assigned to whom? What is licensed and what is not? What, do you have royalties for that? What is registered? What has created by staff or suppliers or contractor? What exists only as an assumption? And sometimes you have big assumptions in your organization when you believe that is because it has been normalized. It's something actually, oh yeah, that's the way that we do things here. That is normal for us. That is a big assumption in terms of, for example, intellectual property. So if the paperwork is unclear, the value becomes harder to price and easier to question, and you don't want like that. You don't want to have these questions in the meeting rooms and caught you by surprise, so you can prepare for all these things. Problem number three is that fundraising begins before the company is ready for due diligence, and I've seen that many times. When you prepare a spreadsheet or a pro forma or projections, and then you start to be asked for many different pieces of evidence or paperwork, etc. And you say, why this? I already produced that, because you know that, and it's true, you know that, and you have your evidence, but perhaps in your mind, perhaps in your office. But when the lenders, when the investor, when the shareholders are looking into your very well put together plan, they will say, okay, now I need to see this, where it's coming from. And they start to drill down, what is called drill down into the paperwork, and the company is not ready for that. So it seems that delays are losing the momentum that you're looking for, but the market sees missing proof as a risk. That's why they do that. And this is a painful mismatch. And believe me, it's very painful to see, because you see all the enthusiasm, all the energy, all the possibilities, but then you have to stop for a second and say, okay, that's all fine. Come back next week, or all the list of things that we are looking for. And you see the faces like, oh my God, I have to do this? Yes, you have to, unfortunately. So going out too early can expose weak numbers or unclear ownerships or tax questions, contract gaps, or unfinished operation models. So you will start to realize, actually, while the plan might be amazing, some things are not completely wrapped up, if you may. So the company then spends the next 6 months answering doubts it could have removed first if they had all things in place. So in other words, imagine raising capital is like arriving at the airport security, right? So we don't like it, but we have to go. Now, you have to go through that airport security. You have a very strong reason to travel. You may know exactly where you're going. You might have your ticket in your hand, and people understand all exactly. And you can explain that for hours and hours and hours. But if your documentation is not in place, or you can prove that, like a passport or identification card or whatever is the case, you are not going to pass through. Unfortunately, you are not going to pass through. So imagine that the airport security is like the gate to that you will find the other side is a capital, right? So you had to go through all your planning, that you go boarding the plane, traveling, off boarding, etc. But the point is that you cannot start that process if you don't have your documentation to go through that security gate. So be ready with evidence is asked before that happens. So when, and you know, documentation is easy because you have your card, your ID, your passports, etc. But if you lose it, oh my God, that is a whole adventure to get that renewed, reissued, or even a temporary documentation. So do that before even going to the airport, meaning the bank, investors, or the shareholders. So As a board advisor, what I would propose to consider is the following. Number one, start with a revenue quality sheet. Show revenue by customer type. This is a documentation. This is the things that you need to get prepared, right? So I'm giving you a list so you can watch this later on, but have this ready, or as you go along, before even asking for capital, do this. Show the revenue by customer type. Show the repeat revenue against one-off revenue, which is one and which is the other. Show gross margins, cash timing, which is the moment from invoicing to collection. Show the customer concentration, so how much business is coming from which customer. Show the cost of delivery, show the top 5 risk to the forecast. And you say, why I need to show the risk? Because that shows that you're aware of your business. You show awareness. You know what you're doing, because you're not only understand the good things, also have a prevention and treatment for the risk in your business. And then ask, what happens if you as a founder are not involved in those sales? What is the preventions or the treatment for that case that you are not there? Who is your hierarchy of decision in your company, your succession planning, if you may? That one question also reveals whether revenue belongs to a business or still belongs partially or completely to you as a founder. And this is a very important question to ask even before it's asked. The second thing is another list. Build an asset ownership sheet. And this shows where the intellectual property sits, show which company owns the contracts, show which entities invoice customers, what is the license, what is registered, what is protected, what has not been yet documented. And you can put that up front, because then you show awareness of where the risk and the rewards sits in your company. So a board also should never have to guess where the company's value lives, right? The valuation, the values of the company, if you're forming a board or you already have a board. The third thing to do is, the last list, is build a capital readiness sheet. How much is being raised? What is the money for? Which milestone will the funding achieve, right? What proof supports the valuation? What will an investor find during due diligence, right? So all these are your checklists, the things that you do internally. Then a very good one, what needs fixing during the next 30, 60, or 90 days. And all these 3 points will open some very good questions to consider. So when you go through this questionnaire, the things you will find is the business has a strong opportunity, but the evidence is not yet organized around how investors think. And this is a key point. You are not doing this ask for capital or raise from your point of view. You have to also to satisfy the other side point of view, the investor thinking. So you want speed, that's perfectly fine, but the market wants clarity. So you have to be very clear how to do and present things. And the preparation is being treated as delay. You might say, well, this is delaying everything. In reality, preparation is what protects negotiation strength. You want to be in a very strong position when you're going. It's like an athlete. They don't win the championships on the field. They win it in the preparation, in the training, in the repetition of having everything ready to go, and several plays, if you may, to understand how they're going to do it. So this is where the advisory board helps. The company may need finance expertise, legal or tax judgment, or help with intellectual property, revenue, quality, commercial modeling, or investor materials. So the advisory board becomes the connective tissue between the expectation of the institutions and the vision you, as a founder, have in your mind, and what the market expects to see as evidence, track record, and predictability to join if you invite them to join your venture with their capital. So expecting one permanent hire or hold all that as a one single package could be a big ask. That's why the advisory board brings the right mixtures around the milestone and helps leadership to turn scattered evidence into a fundable case. So what do you gain working with me? 3 things: business outcome, differentiators, and risk reductions. The outcome is a capital readiness plan that moves the company from we need money to grow to we can show you why this business deserves an investment. It's a very different position to be, and a very good one to be. We can show you why. The differentiator is a rotating international advisory board that match to the predictability milestones. So you get investor readiness, finance, legal, tax, intellectual property, and commercial judgment faster than hiring one executive with a lower overhead than a big consulting firm. So you have everything in one controlled environment, and there's no talent locked in, because once you go from your, we went yesterday from scale, today we are in predictability. So when you're moving through different stages of your milestones in your organization, you need different talent. Yesterday we spoke about marketing, branding, sales, HR. Today we are talking about taxation, intellectual property, law, and judgment in terms of investment readiness. So you see this different pool of talent from one to the other, and we can swap members every 6 months. Now, one action you can take home today, and it's doable in 30 minutes or less. If you take more than 30 minutes to do this, probably you have a big challenge in front of you. And this is our visual aid, what we need to do. You can create this fundability scorecard. It's very simple. Use the 3 columns: partnership, revenues, and assets, and mark which is the status of each one. It's a red and amber and green. And you have the list of questions that I prepared for you and which is discussed already. So with that color, before putting the color, put the evidence that is ready for fundraising, right? Like your partnership ready, your revenues are ready, your assets are ready for fundraising. And then put a color there. And the color that has the most weakest areas, probably amber and red, is the first thing that you have to do in the next 90 days. That is your roadmap to make sure to address all the right things in the right place at the right time. So let's pause it here for today and reconvene tomorrow, because tomorrow we move into system, which is the bottom of the advisory board operating system. This is because clean numbers only help if the governance, the controls, the reporting, and the structure can hold when the growth starts moving faster, right? So when you might have a very powerful engine in your organization, which is a capital, but if the structure or your car or your wheels or your transmission is weak, then you have an issue, because probably it's going to, instead of achieving what you want to achieve, is going to make a lot of challenges to the driver of the organization, because the machine is, even if having a powerful engine, the rest of the machine is not ready for the speed that you are looking for. So if you are preparing for invest your company, to look for investment, market entry, or trade, sale, or a future public market rating, whatever is the case, and you want an international advisory board to strengthen the evidence behind your capital case, let's have a 30-minute call, so I can understand where you're coming from, where you are, where would you like to go, and how we can put together an international advisory board that can help you to achieve that. Have a great day, and I'll see you tomorrow. Thank you, and bye-bye.